The S&P 500 as well as AMC had yet again very volatile days. We have our Fed meeting coming tomorrow, which we will touch on that. But I want to pitch to you guys the bullish case here. I know everybody is screaming from the rooftops to buy puts. The stock market is going to absolutely crash. Now, I have a contrary belief to what a lot of people say. I actually don't think the markets are going to react very, very bearishly. Now, if they do, I will give you guys the key levels to which we could fall to. Now, there's a clear reasoning why I'm pretty bullish going into the Fed meeting, and that's what I want to go over with you guys here in this video. Hopefully you see this before tomorrow at 2 p.m. and then 2:30 p.m. when the Fed actually does come out. That's the goal. That's why I want to make this video right now. As well as that, we will talk about what happened today with AMC stock up 1.64% and how that could be a precursor to what is to come next. So hit the like button, subscribe to the channel if you guys find value out of this video. If you guys like these more macro style videos, then definitely subscribe to the channel, like the video, comment down below, all of that stuff lets me know that you guys like these videos. You know what I'm saying? So without any further ado, let's talk about it, guys. So what's the main thesis right now? That investors are concerned about growth in the economy. They are concerned about what the Fed is going to do, which that is the case. And I am not advocating the stock market is going back to all-time highs anytime soon. I'm not advocating that we could not drop lower within the next couple of months. I actually think we will drop lower within the next coming months. That's why I think the MOAS will happen really end of summer through, about October, November. That time frame, I think the markets are really going to be at their lowest levels. Now, that's kind of a topic for another video. We're talking about the short term here, the next couple of weeks. And I think there's a pretty big opportunity to be had. Now let's go ahead and we'll look at the technical picture here because this actually looks really good for a bullish reversal. But I do want to talk about the last Fed meeting and what essentially happened. So the last Fed meeting, the markets pretty much sold off from the first of the year. Literally the high of, the whole entire stock market's history was January 4th, 2022. That was at $478.49 per share on the SPY, stands for the S&P 500, if you guys did not know that. Now, the stock market heading into the Fed meeting had fallen all the way down to about 414. We clipped under that a couple periods throughout the day. And then the Fed meeting actually came. We got a 0.25% rate hike. We got the plans for the balance sheet reduction. And the stock market proceeded to go on a very historical rally. Even if you look at March of 2020 in here, yes, we've seen some pretty big days. Like this day was about a 6.71% positive day, which was absolutely massive. Probably one of the biggest days we've ever seen in the history of the stock market. But this whole period was just a prolonged move to the upside. Why did that happen? Well, there's a simple logic here. Everybody knows if you trade penny stocks, especially penny stocks or biopharma penny stocks, to be more specific, buy the rumor, sell the news. You tend to get stock prices going up on a positive rumor. And then once that positive rumor does come out, even if it's better than what people had expected, the stock tends to fall after that. Now, you're kind of seeing the opposite happening right now. It's like short the rumor, buy the news. That's what you seen last time around. But this time around is a little bit different in that regard. Kind of the same way though. Like look right here. We fell all the way to 409.37, rebounded a little bit to like 414. Like I said, you kind of flushed those lows, came back up, held this range, and then continued to rally. That's kind of what we seen right here. You came down, flushed to the lows of 405.02, and then you're kind of consolidating sideways. And I expect tomorrow up until at least 2 p.m., 2:30 p.m. to be a consolidation day. After 2:30, that's where you're going to get a big move, right? The stock market's going to move huge around then. It wouldn't surprise me to see a 1 to 2%, couple of candles after 2 o'clock to the upside or the downside, right? So you're kind of seeing the same thing playing over again. Now, the biggest key, think to yourself, I say this all the time, but it's very important. The only thing the stock market hates more than bad news is uncertainty. And what does this Fed meeting do for the markets? Well, it's the most uncertainty you could possibly have. Yes, like I said earlier, investors are worried about economic growth. Yes, they're worried about the possibility of a recession. Yes, they're worried about what the Fed will ultimately do. But on the note of economic growth, the Fed really holds the torch in that realm. The Fed single-handedly can destroy demand, and that's called demand destruction. If you guys have not heard that term before, you will hear that a lot over the next year. Or the Fed can be more accommodative to the markets. Now, in this case, I think it's simply we have to get the bad news out of the way, and then we can rally. Now, let's take a look at exactly what's going on behind the surface. Because right now, hedge funds have the least amount of net long exposure to the stock market since 2008. What does net long exposure mean? Well, that means out of an equity portfolio, let's say you had $100 in stock, you had $50 short. Well, you'd have a net long position of about 50%, right? So that's important to know. That's not exactly the number, but it's very low. Percent. Right? And I do an article. Came out March 15th, the day of the Fed meeting at 5:16 a.m. 2 months ago. It says investors dump stocks, flee to cash as growth outlook hits weakest since 2008. And this was peak fear before the Fed meeting. People thought the markets were just going to get destroyed, like absolutely destroyed. We hit a low of 417 and then came back up to 424.85 by the end of the day. That was a 2.20% positive day. But what happened? The Fed was out of the way. Then you've seen a 2% positive day, another 1.25% positive day, another 1.10% positive day, slight down day, and then another 1.7% update, and it keeps going like that, right? So you guys get the idea there. Now, something else I do want to point out is the put to call ratio. So the put to call ratio right now, it says total put to call ratio is 1.22. But I want to point out the index put to call ratio is 1.52. Now, what is a good put to call ratio? So an average put to call ratio of 0.7 for equities is considered a good basis for evaluating sentiment. In general, a rising put to call ratio or greater than 0.7 or exceeding 1 means that equity traders are buying more puts than calls. So right now, we're sitting at 1.5. That means for every one call that is placed, there is essentially 2 puts that are placed on the market. Now, what does that ultimately do once a big catalyst is out of the way? Once fear, a lot of fear, not all fear, but a lot of fear leaves the markets. Well, it puts a lot of those people that bought those puts in a very bad situation because they dramatically will start to lose money on them as people, like I said, get over the fear, they sell out of those puts, they go long again in the markets. Typically, when you see sentiment this low, you want to be a net buyer of calls or have a lot of exposure to the upside. Crashes don't go down in a straight line. And I will tell you right now, the stock market will not break and hit a new low, like under 400, 380, 360, 340 on the S&P, which is likely coming, but it will not happen until something breaks. Either China collapses, Europe collapses, we head into a recession, or economic activity just ceases to exist. Demand destruction, it just ends everything, right? All economic activity, or a lot of economic activity. That's when the markets will finally break, once the fundamental picture changes in a very substantial way. So it is not right now. Right now, it's not bad enough, like we don't have a technical recession. China is accommodating their markets. Europe, not in a good situation, but it's not quite there. So unless the Fed comes out and raises rates by like 1%, or 0.75%, or says they're gonna reduce their balance sheet by $2 trillion, then you're not going to see the markets collapse like a lot of people expect they will. There's too much bearish sentiment. And usually when there's a lot of bearish sentiment like this, you don't tend to go down after that, right? You tend to go up. So this is all statistical here. The statistical probability when everybody is this bearish of continuing to see the markets go down unless there is a systemic issue like 2008, a real financial crisis where banks were going under, or a pandemic that shuts down the economy, it's very, very hard to get to that point. Even the latest example of all of this that I could even give you is 2019, when the stock market absolutely freaked out. And this lasted a while. From January 2018, you're up, you're down, you're up, you're down, come up, hit a new all-time high, and then fall straight through the floor. And all in all, this took a whole year for this to happen. A very turbulent year overall. There was no market direction. You're up, you're down, new low, new high, just everywhere, right? Kind of reminds you of what you're seeing right now. What actually happened during this time? It was the balance sheet reduction. Now, when did the Fed start reducing the balance sheet? Well, they started reducing the balance sheet in early 2018, right? And it didn't actually hit its lowest moment until August 2019. So if you actually look at the S&P, what happened here? Well, towards the end of 2018, long after the Fed started reducing its balance sheet, you actually hit that new low. And this was down about 35%. Obviously, the chart's different because we have went up a lot from that, right? But you guys get the idea. It does not happen right away. It happens over time, especially once rates start to go really, really high. But what I will tell you, if we do go ahead and look at real rates, like what you and I would borrow money from a bank for, it would be more in line with the bond market because they're competing asset classes. You are much more risky than a US 10-year treasury bond from the government. Or in other words, the government's going to pay you before you pay back the bank. I think that's fair to say. So a lot of loans revolve around this. Now, what essentially the markets have been doing, especially over the past year, this looks like a damn momentum stock, right? It's pricing in very high interest rates. So this might actually take a little bit of a breather. If this takes a little bit of a breather, that's where you can come down a little bit. And just for reference here, do you guys remember this, what I just showed you? The balance sheet being reduced in a very dramatic way, going from about $4.5 trillion all the way down to the low at about $3.75 trillion, down about $800 billion, give or take. Well, what the balance sheet reduction actually is the Fed either selling assets off their balance sheet or letting them roll off. And long story short, without getting into it too much, it raises the yields on treasury bonds. So let's look at 2018, 2019. The yield in 2018 topped out at 3.23%. Well, we are already at about 3%, 2.98%. to be clear. So there's been a lot of economic tightening just in the last couple of months. Not everything goes in a straight line. So either this is telling us that we're going to see rates, treasury rates, real interest rates that will destroy the economy at this pace, or it'll take a little bit of a breather before it destroys the economy, and we could see a short-term rally. A lot of economists are calling for a 7 to 10% rally after the Fed. I don't know if I would give it that much. That would put the S&P, to about 440, but I definitely think the range, a reasonable bounce range for the S&P could be, 435, 430, possibly 440. I don't really expect these 450 highs unless the Fed says something that we really, really like, which is possible right now. It's very possible they come out, raise 0.5%, and they say, hey guys, we're starting to see things looking a little bit better. We can kind of wait out the next Fed meeting that comes in another month. We're not going to really give you guys another rate hike during that time, but we might start reducing the balance sheet. That could be seen as a bullish thing. Now, the balance sheet is going to be the most important thing, so maybe they just decide to raise rates in general and hold off on the balance sheet. There's a lot of different ways it could go. There's ways it could be negative. There's ways it could be bullish. But what I'm trying to say is that the markets have already priced in a lot of bad news. We are sitting at the lows like we were during the last meeting. The 10-year treasury rates, the bond yields have went insane. There's no other way to put it. Like it's straight vertical when we just showed that. And the financial markets as well as the economy is not really at a breaking point. There's not a real systemic problem people can point to. There's company earnings are coming out good. Like look at these companies that are reporting earnings. Airbnb did phenomenal. It's not being rewarded very well today, only up 4.28%, but this is already a very high value stock. This is a $100 billion market cap company that makes about $2 billion of, revenue of sales per quarter. So very, very high valuation there. And that's even doing well. And it's sustaining its valuation. Look at AMD, up 4% here in after hours. That's one of the main headlines here on CNBC. Look at that. AMD sales jumped 71%, shrugging off concerns about PC slowdown. Apple earnings were good, but they did forecast that declining, I don't know if you'll call it growth. That's what people are kind of saying about it, but it was really issues in China. I mean, I don't really believe anything Apple says. I think they try to cushion any bad news with other things. Topic for another video, but still, you can't really point to Apple and say that there was a huge issue. Apple beat on all metrics. Unfortunate as that is to say, I think that's later into the year where Apple will really show a lot of slowing down. Microsoft did very, very well. Google actually did well. Their stock did come down a little bit, and then it did proceed to rally after earnings, but they missed a little bit, but the earnings were actually great. The business grew by like 25% year over year. So they were good. The only real earnings that were terrible was Amazon. And that's a problem. Even Tesla did very, very well. Airbnb beats estimates with 70% revenue growth as travel rebounds. So it's not like we're seeing terrible earnings across the board. It's not like the fundamental picture is just dissolving in front of our faces. It's actually quite the opposite. A lot of earnings, about 80% of earnings are coming in beating expectations. And that, I believe, will be seen as a bullish thing as long as the Fed does not disrupt the markets all too much. And if you really want to compare this to 2018, 2019, you could say we just went through the first round of 2018 right now, right? You come down, boom, you flush out this day, and look at that wick. You came all the way down. A low of 236, a close of 244. Come down, flush down, come back up, come down, almost hit a new all-time, well, at this time, a yearly low. And then you go back up, you come back down, and then you steady trend to the upside. Now the markets are a lot more volatile, so it's either going to be straight up or straight down. That's at least what it feels like. And then you come back up, hit new all-time highs, which I don't necessarily think is going to happen this time around, and then you come down almost a year later, 11 months later, right? So markets are different now than what they were then, but I think we've priced in a lot of bad in a very short amount of time, and there's a lot of people positioned for a lot of red in the market. We'll just call it that. So it never tends to play out like that. I'm not a fortune teller. I'm not a financial advisor. I'm not going to tell you guys, what to do with your money. But I personally think there's a greater likelihood of seeing a bounce rather than seeing the markets go under 405. Now, if the Fed is bad, expect 405 to be a lot of support, just like we've seen right here, 405.02. We literally bounced right off of that with a very, I guess, call it another historical rally during this point, right? We went all the way down to 405.02, and then we closed the day at 416.38. That was a reversal of $11.36 per share from the bottom in about 45 minutes. So I think you got that flush. I think you got that flush out, right? And I'm more bullish than not. But watch 405 if we do come down. 400 is going to be the main level because, I mean, you're in no man's land in that point. There's no telling how low it could go because we did even gap up back here in 2021 from about 385 all the way up to about 400. So you're kind of in no man's land there. I don't expect the stock market is going to break unless we have something fundamentally changed. You know, if earnings were all terrible across the board, then we would be having a different conversation here. The markets trade off of fear and greed, number one, but they also revert back to fundamentals when it comes down to it. And the markets right now are fairly priced for a lot of stocks. Some are overvalued, some are substantially undervalued, but a lot of them are fair value, especially some of the large tech stocks that control a lot of the market. So that's my overall theory. You do have the JOLTS jobs report that comes out in the morning. That's expected to come in at about 11 million new job openings. That could go either way. You know, too many job openings could be seen as bearish or bullish. I don't think that's going to move the markets in a big way leading up until the Fed report comes out at 2 p.m. Eastern Standard Time. The press conference comes out at 2:30 p.m. Eastern Standard Time, and those things are what is going to move the markets in a very substantial way. You're going to see huge candles around that time, so make sure you're either positioned for whatever direction you want or you're very nimble. I don't think it's a bad idea to wait until after the Fed meeting to potentially play a, you know, bullish reversal or a bearish decline, because after all, you know, we don't get the news early in the morning. The markets will open, they will be trading at the time, and you could afford to wait until after the Fed report does come out to initiate any trades. But again, not a financial advisor. Come to your own conclusions and leave your thoughts down below in the comment section. What do you guys think about this information? I know this is going to be a long video, so shout out to you guys that are still here. Now let's simply talk about what happened with AMC stock today. A lot of stocks were down quite dramatically. And I said this in the last video, but I think it's important to point out that these stocks, especially the momentum runners, they just ping pong off each other, right? Look at this heavy volume that started to come in towards the end of the day around 2 p.m. The stock went from 1473 all the way up to 1611. This was a massive reversal, almost a $2 reversal, right? From the lows to the highs. The stock went up about 5%. Topped out, markets got very volatile and very weak, and then the stock fell, stock came back up, and you're seeing a little bit of back and forth ping-ponging action here in after hours. But what it really comes down to is a lot of your other stocks, a lot of your red box stocks, a lot of you know, ATERs of the stock market, or just other high-flying potential meme stock names, they took their foot off the gas today, and a lot of them went down. Redbox was down almost 20%. I believe they closed down about 18 to 20% at the end of the day. So a lot of money just flowed back in AMC. People love to say, you know, they buy and hold and all that, but a lot of people do just bounce their money around and trade these different stocks, which I'm not going to tell you guys what to do. I don't care who buys or who sells, but that's what happened with AMC stock today. Now, if the Fed is gives the markets a bullish tone, look what happened the last time. AMC was at $12.90 per share, ran all the way up to $35 per share. When we got halted, came straight back down. This was a very sad day for a lot of people, including myself. And then we've continued to sell off. Now, if we get another bullish Fed, it would not surprise me to see some level of similar price action happen to AMC stock. I would definitely watch $15 per share. That's the level I've been calling out. We've, you know, went under 15, but we have not closed under 15. We've always found solid demand under 15 intraday and have came back up above 15. You guys can see the low right here, 1461, the close, $15.26 per share. The low today, 1473. The close today, 1551. So I want to see if that trend does break. If we hold above 15 tomorrow, if the Fed is bearish or bullish, I think it could have some huge implications for AMC stock. If the markets do just take a dump after the Fed, then I would watch $13 per share, specifically $12.90, because that was the low back here. But I don't think it's very likely to actually see, like I said, the markets to continue continue to come down in a substantial way. Now, let's go over the Ortex data, then we will go ahead and wrap up this video. So you actually did see a switch towards the end of the day. 22 orders totaling $3.55 million, positive order value of 65%. Look at all of this bullish option activity coming through. Virtually all of this is call activity, and a lot of it is targeted for right here, May 20th, $16 call to June 17th, $18 calls, and then some 2023 expirations for January 20th coming in at the $15 call strike. So you've seen a large reversal in the option flow sentiment, and I think that could give us some clues to what is going to happen tomorrow. Now, as far as the short interest, continuing to climb today at 19.02%. Current shares that are sold short of 98.03 million. Cost of borrow max of 2.73%. Utilization of 100%, and days to cover sitting at 2.59. So that is pretty much going to be all for this video. That's what you guys need to know. If you do look, and you could do this for yourself. It's nothing too crazy, but if you just look at the SPY on a 15-minute candlestick chart, you could see we were just up here at 450. We've been in a continuous downward trend for a while now. Hit that low at 405, and now it looks like you do have a slight reversal bullish trend that is starting to actually play out as of right now. But we'll see what happens with the Fed. I don't want to get you guys too excited or potentially change your beliefs too much. That's not the point of this video. It's simply to say, hey, this is what we have. This is what typically happens when this happens, aka everyone is bearish on the Fed. It does not tend to lead the markets to go down unless you have some kind of systemic problem like a recession right around the corner, which I do think is coming. But earnings, especially at the largest companies in the world, like your Apples, Teslas, Googles, were not bad enough, in my opinion, to get that flush out. So that is going to be all for this video. Hit the like button, subscribe to the channel if you guys like these kind of videos. Hopefully it helps you guys to make some money. If it does, and you guys want to come join the trading community, link down below in the pinned comment. Thank you guys for watching, and I will see you in the next one.